Hi everyone, welcome to today's video. I'm Nathalie Goldstein, CEO of MyExpatTaxes. Let's dive into what are the best tax planning tips to keep in mind before you make that big jump abroad. And after you jump abroad, you know to use MyExpatTaxes, the leading tax software for Americans living abroad, to help you with your international tax filing needs. So, first things first, how do you actually break US tax residency? Do you need to stop filing taxes when you move out of the US? So unfortunately, the answer is no, you don't stop filing US taxes, because if you're a US citizen or a US green card holder, even if you move abroad and you're no longer actually residing in the US, you have to still file your US tax returns. You don't actually break tax residency. However, I will say if you're not a US citizen, you're not a US green card holder, and you are just living in the US under a different visa, maybe you qualified under the substantial presence test, if you do leave the US, you will technically break tax residency. And then in that case, you would start filing Form 1040-NR. But for all us US citizens and green card holders that are moving abroad, we're still filing Form 1040, which is for us abroad, and also obviously the return you were filing when you were not abroad as well, because the US does not care if you live abroad or not. So while as a US citizen or green card holder, you can't really break, US tax residency for federal purposes because you're still filing that US tax return from abroad, you can definitely take steps to break state tax residency. So especially if you live in states that are a little bit more aggressive about taxing your income, what people would not normally, but what some people do is they actually move to a different state before they move abroad. So they'll move to a state like Washington, which has no income tax. Obviously, I don't think this is possible for everyone to just move to another state before you move abroad. So what you can do that's a little bit more practical is if you have property, maybe you rent it out, right? So that it's clear that you're not intending to live there. If if you're moving abroad, make it really clear that you're moving abroad. So establish a home there, tax residency, make sure that your kids go to local school, you go to the doctor, dentist, like really these are the facts, right? That do you have a life abroad, or are you returning back to California or a different state every 3 months to go to your normal dentist? So I don't think that they'll go down to that level to check it, but this is really what it means about tax residency is where are you domiciled? So again, things you can do is rent out your property if you have any, you can sell it. If you still have driver's license, I don't think you have to go and get rid of them, but maybe don't, renew them when they expire. Definitely still vote at your state, because voting in the state will not impact your taxes. So I know that that's something you can hear around, but state residency can be broken. Just make it very clear that you have moved somewhere else and you live somewhere else. So now another big question is, when should you plan the big move? When is the best time to actually move abroad to minimize your US tax liability? So generally, that is if you move abroad earlier in the year. So obviously not everyone can move on January 1st, but it's always the easiest if you really kind of have your life abroad start earlier, because then you have less US income, right? And then you can more easily qualify for expat tax benefits like the foreign earned income exclusion or the foreign tax credit approach, etc. Because you just have more time living abroad and, establishing a tax residency somewhere else. So another reason why moving abroad earlier in the year is generally better is because it helps you qualify for the expat tax benefit foreign earned income exclusion. Because generally, when you first move abroad, that first year abroad, if you're looking to claim the foreign earned income exclusion, it's going to be a little bit trickier. If you're living abroad for a full year, January 1st to December 31st, uninterrupted as a tax resident somewhere else in a different country, as a registered resident, paying income taxes there, or at least being subject to income taxes if there are income taxes, you could just qualify under the bona fide residence test. And then that means you could actually travel back to the US as much as you want. However, in the year you actually move abroad, you generally won't qualify unless you move on January 1st. And so what you actually will do is you'll look to qualify under the physical presence test, which means you have to be abroad for 330 full days in a consecutive 12-month period. So again, the earlier you move, the easier it is to qualify for the foreign earned income exclusion, because you just have a lot more time to qualify for that. Now, going with the topic of minimizing US tax liabilities, when should you pull out all of your income? So if you have income or, investments, individual retirement accounts, things that are still in the US, should you try to accelerate all of that income and pull it out now before you leave the US? Or should you defer it and leave it in the US while you move abroad? So generally, there is no real need to pull out that income ahead of time because the way you're being taxed is pretty much the same whether you're in the US or abroad. But of course, something you do want to consider is that if you have a lot of US income, if you pull that out while you're abroad, your new country may also want a piece of that income and may also tax it. But obviously, because of all the numerous tax treaties, there is a way to claim any income taxes paid abroad on your US tax return to get a credit. So, it's kind of up to you if you want to pull out the income before you leave the US or you're okay to kind of pull it out as you're living abroad or later. So now diving a little bit deeper into the topics of having maybe an individual retirement account. So in the US, it's really common to have maybe a traditional individual retirement account. And this gives you tax deductions immediately on your US tax return in that year that you contribute. However, when you move abroad, because most expats end up not owing any taxes with all of the expat benefits available, sometimes it's not that beneficial to have a traditional IRA anymore because you don't need that immediate tax deduction. So this might be something that you think about of maybe having more of a Roth IRA. So when you move abroad, maybe you don't contribute anymore to your traditional IRA, but instead you look to contribute to a Roth IRA that you contribute to with after-tax dollars. So you have no immediate tax benefit. However, you get the tax benefits when you draw the distributions. Going back to the topic of when you should be realizing your income, I do want to note that if you are, again, someone that's not a US citizen or US green card holder, and you are in the US and you no longer live in the US, so you no longer have to file a US tax return 1040, maybe you do want to think about your capital gains a little bit more. Again, the question always is that if you don't live in the US anymore and you pull out your capital gains while you're living abroad, your local country may want to tax that income, right? There's nothing that's really in scope for this video. But if we're talking purely from a US tax perspective, if you leave the US and you're no longer needing to file Form 1040 and you file Form 1040 NR, and you are not in the US for more than 183 days in that tax year, you can actually pull out capital gains from the US tax-free. So that might be something you want to think about, that if you have a lot of capital gains accumulating in the US, that you actually leave the US, you break tax residency, you become a non-resident alien, so to say, and then if you then pull out all that income, you'll still get a Form 1099-B, but you don't actually have to report any of that as long as you're filing Form 1040 NR and you're not in the US for over 183 days. If you're in the US and you have some type of business structure going on already, so maybe you have a single member LLC or even something more complex like an actual corporation or an S corporation, well, how would you actually restructure those when you move abroad? So if you have a single member LLC, obviously depending on the country you move to, it actually doesn't really matter from a US tax perspective, because if you're filing Schedule C in the US while you're living there, you'd still file Schedule C for your single member LLC when you're living abroad. Now, the thing about it is that, we all know if you're a single member LLC, you're probably paying self-employment taxes for the US. If you are living abroad, you might actually be able to claim a totalization treaty to not pay those self-employment taxes anymore, depending if you pay it, obviously where you live now. Corporation and S corporation, that gets a little bit more tricky. What I will say that a very common misconception is that an S corporation will be as beneficial as it is while living abroad, because if you pull salary from an S corporation, you can definitely still use the foreign earned income exclusion, but just keep in mind the distributions or pass-through income that you would normally see on an S corporation that is not salaried income, that is not eligible for the foreign earned income exclusion. When you're looking to move abroad, you're probably introduced to a lot of different types of visas. And it's sometimes common that in order to secure a certain type of visa, you'll have to make, type of investment in that country. And that may come in the form of opening a trust or a limited liability company. And so what happens then? What happens if you open up a foreign trust or a company abroad? So even if that may give you some nice tax benefits locally, that can definitely make your US tax filing a lot more complicated. So just something to keep in mind if you're gonna go down that route and open some type of legal entity where you're living, you might wanna use MyExpat Planning to understand what that really means. Because if you open up a foreign trust, maybe you're filing Form 3520, which is a very complex and high price form because it's so manual and there's so many things involved. Or if you're opening up a company or a partnership, you might be filing Form 5471 or Form 8865. And again, all of these different forms also come with different penalties, different taxation rates. So can be simple for your life abroad, can definitely make your US tax filing more complex. And finally, if you're actually planning on retiring and then moving abroad, this might be important for you. What happens to your retirement income? How is that taxed? If you get foreign pension income as well, how is that taxed? So generally, if you have some type of Social Security benefits, state-funded income, whether the US or foreign, the tax treaty, depending on which country you live in, will specify which country can tax that income. So it's normally not double tax. And if you're unsure, you can always use MyExpat Planning to decide, okay, is my US Social Security still going to be taxed when I move to Germany? So that is kind of the first part. Obviously, if you have any other type of pension income, private or company funded, this normally will be taxed in both countries, but obviously you can use income tax credit. So if you pay income taxes in your local country, you can use that as a foreign tax credit on your US tax return. So in the end, you are not actually double taxed. So I hope you found all of those tips helpful. I'm a US expat myself, and here at MyExpatTaxes, our goal is to make life simpler for our fellow expats. So subscribe to this channel for more clear, actionable tips for US expats around the world.